G'day, in this week's video we're going to compare paying your home loan off compared to paying into superannuation and do the calculations around it to assess it so we can get our repayment options right. Again, thanks for joining us. So we're briefly going to have a look at and break down paying your home loan off compared to making superannuation contributions. We've done some of the calculations around this in the past. It's very much a tax-driven issue, whereas you've got to pay your home loan off using after-tax dollars, where superannuation using salary sacrifice is going to be with pre-tax dollars. So what we're going to do is quickly have a look at obviously the two options, and to start with, we need to have a look at the marginal tax rates. And we've got to make some I suppose a little bit of work to decide where we're placed on the level of tax and what percentage of tax that you would actually be paying. So we can see here between $37,000 and $87,000 that you're going to be paying 32.5 cents tax for every dollar that you earn over, and you can see that goes up as we go up the income level. We've got to add 2% Medicare levy to this as well, so we need to take that into account. So if we use this marginal tax rate as our benchmark for the examples moving forward, so it's 34.5%. So if we're to look at the home loan repayments, so we've really got an interest rate cost of 4%, and we've got to pay that for after-tax dollars. So if we look at a block of money of $1,000 pre-tax, then we've got to pay your tax at your marginal tax rate, and we're using the example of $37,000 up to $87,000. You've got to pay 34.5 cents on the dollar, which means after tax, your $1,000 that you've worked very hard to get is worth $655. Then if we look at superannuation, again, a pre-tax contribution into superannuation is going to be taxed at 15%. So what will actually stay in superannuation after you pay a smaller amount of tax, the 15%, you're going to have $850 working for you. So when we look at the savings between the two, the home loan repayments, $1,000 worth of hard work, is going to pay $655 off to save 4% interest. Obviously, home loan rates are extremely low. In fact, they're historically low. So you're paying 34.5% tax to save 4%, whereas superannuation contribution going into your super from a pre-tax point of view, when we take into account the 15% tax, you're going to save 19.5% tax. So in terms, and as we get older and we get closer to accessing superannuation, mid-40s and above, this is where I think people should be assessing their home loans if they've still got them. Are we better off to reduce the amount that's going into our home loans? Perhaps we pay interest only, and we really make our first priority in saving be superannuation, so we can lock in this 19.5% saving each and every year. And we've got to assume this interest cost, we can make money on this $850, so assume that's 4%. Well, 4% that we make on 850 is going to be a lot better than saving 4% on 655. So anyhow, that's probably the one to have a think about. If you like the video, give us a thumbs up. Please subscribe if you haven't already. And as you know, there's other resources down in the description area down below in the video. So thanks for watching. We'll catch you next week. Thanks for listening.